but welcome and thank you for sticking around for the graveyard shift. So Nairobi's hotel pipeline is at record levels, but the key question is this growth actually supported by demand, or are we starting to misprice risk? So we have a great group of panelists here today, a mix of investors, owners, operators, brands, actually quite a large panel. So I think let's dive right into it. If you had to deploy capital into a new hotel in Nairobi today, would you actually do it, and in which segment? JS, let's start with you at the end.
Definitely. I mean, I think there's more opportunity from lifestyle kind of concepts in Nairobi because there's a lot of big box players here already, and a large amount of focus on the, in terms of luxury segment by a sense of arrival experience. So yeah, there is opportunity. It's a dynamic market. I think the demand is there, but there is still scope to look at mid-scale, upscale products.
Dan?
Yes, we're very interested in Gigiri, the UN corridor, and I'll try to capture the kind of long stay market there, which I don't think is being met, and probably a kind of upscale lifestyle product.
Michael?
Look, it's a great question because clearly the rumor in the room is perhaps there's an oversupply, but absolutely for the right project, I think location specific. There are certain nodes that still definitely have huge opportunity and others less so. I think it also depends on the development costs, so that whole viability exercise, which we see often is miscalculated by clients who then overspend and the market can't bear to get the decent return. So yeah, selectively, but definitely.
Right. Jameel, maybe bringing you in from an operational standpoint, are you actually seeing demand keep pace with supply coming online?
Can you hear me? Yeah. We entrepreneurs are optimists, so the answer is that we believe that the recent wave of new product that's entered the Nairobi marketplace in the last 18 months has actually been relatively stable in terms of occupancy. So we see the years ahead as remaining stable, and then hopefully the demand curve matching the supply.
Right. And Charles, coming from an owner-investor perspective, how has underwriting changed versus, let's say, 3 to 5 years ago? Are investors and lenders materially more conservative today?
Thank you. I think there are a couple of things that maybe have shifted, even going by the supply that has come into the market. There's quite a lot of desire for international brands to be part and parcel of the developer's point of view. I think there's a lot of institutional capital that is flowing into that side of hospitality. Previously, maybe not as much. And equally, I think there's a lot of expansion and data that is now coming from the market, which again was not available if you're to think of 3 to 5 years. Those are top of my mind, I think, some of the shifts that you can pick from the 5-year cycle. Yeah.
Yeah, absolutely. I mean, I think there's been 2,000 plus keys coming online just over the past 24 months. But I think that's a good segue into branding. So Dan, maybe we'll start with you. Radisson already has a strong footprint in Nairobi. What gives you confidence the market can absorb more branded supply?
So I think the question really is whether one thinks that there is oversupply in Nairobi or whether Nairobi is a mature market. I would argue that Nairobi is a mature market, but only if the supply is matched by the correct demand segments. Nairobi is, I think, structurally underpenetrated when it comes to branded hotel supply in relation to its position as the commercial hub of East Africa. If we look at population growth, the rising middle class in terms of their income and mobility, airline traffic, etc., you'll see that demand is actually still catching up. Yes, there might be oversupply risk if you look at undifferentiated upper upscale, classic look and feel inventory in legacy nodes. But the opportunity lies in diversifying product. We need more select service, lifestyle, luxury, and long stay product to cater for demand that is there. This is where we're seeing the most growth across our existing portfolio in Africa in equally mature markets, okay? But if we zoom out and look at East Africa as a whole, it's a little bit different to Nairobi. So East Africa as a whole, I think that demand growth is driven more by kind of structural segments. You have NGO travel, diplomatic travel, regional corporate travel, MICE travel, etc., and improving airline quality and connectivity. Demand itself is more city and node specific and not countrywide. So Nairobi, Dar es Salaam, Addis Ababa, Kigali, Kampala, Zanzibar, etc., they all behave very differently in terms of absorption. Okay? So when we talk about pipeline risk, we should talk less about too many rooms and more about misalignment of segmentation. So what we like to look at when we look at the different markets, and it differs from each market, is you have to compare the key metric of net room supply growth versus RevPAR growth. And in some of these nodes and some of these cities, you have net room supply growth outpacing RevPAR growth. So there is compression yield for some owners. But in conclusion, I would say that as an answer to the question generally, supply is sustainable as long as it is demand calibrated and segmented, which is the case in Nairobi for us.
Great, thank you. JS, maybe we can touch on the lifestyle side. Where do you see white space in the market today?
See, I think being a homegrown brand and something that's evolved over the last 6 years out of Dubai, and we've got a couple of assets coming up in Zimbabwe, Nigeria, and also Tanzania. It's a harder sell for us to compete with the big boys anyway, because the number of brands that are in the market from the big players versus also the conversion brands that have come in. I think there's no question of white or black space. We just need to find a space in the first place. So where do we fit in? We fit in to a typical 70, 80 key kind of hotel. Simple, not too complicated from a brand standpoint, cost effective to the ownership. Operating models are relatively, tight in terms of that. So we're focusing on our upscale our 3-star econo, a 4-star that's doing pretty well. And actually we created a 5-star brand called Zen, which is coming out of Lagos in about 60 or 90 days. So I think for us, it's a harder sell. We see the gaps in the market, definitely, in terms of opportunity. But of course, convincing ownerships today with what is actually being offered by other players, it's not an easier sell for us. So we are trying to make a niche for ourselves at this point. But we are relatively smaller. That's the way we want to stay. And gradually grow, because we cannot compete with the big boys anyway. We don't want to. So, yeah, so I think there is space, but we still need to identify it. We haven't done that well in East Africa, but we've been very strong in West Africa.
Yeah, that's an interesting point you make on the branding. And Michael, maybe I can bring you in on this. Do you think brands are genuinely creating new demand, or are they just competing for the same demand pool?
Don't know what you want to say, Daniel. I think 80-20 principle would be mine. I think 80% of me thinks that a branded product is not going to create new demand in the market, but it is going to help those owners and operators to capture more demand because they have the massive advantage of their distribution systems, their loyalty programs, and the like. So I think, generally speaking, that would be my 80% kind of no, but there is an upside. And then the 20% where I'd say they absolutely can help create new demand is when they come into emerging destinations. So if I put a Kenya hat on, I would say, you know, if you look at the safari product, if you look at the coast, if a sexy international brand comes into the market, it can bring with it a following who will perhaps, you know, decide to travel to that destination, which they wouldn't ordinarily have perhaps been on their radar. So I think it's a mixed answer. I think also, you know, lifestyle's been mentioned, I think, by a couple of the other guys, and I think there's no question in my book, you know, we're a global management company, and it's the lifestyle brands that we work with under franchise that are shooting the lights out right now in most markets. So I think the traveler of today, whether it's on leisure, MICE, business, you know, governmental even, you know, people want a different type of experience than the cookie cutter that I think we all kind of grew up with, or certainly have seen in the last 20 years. So some of those brands do ignite a demand for a location, for a market. Yeah.
And Charles, from an owner's perspective, is branding today de-risking investments or compressing returns?
Yeah, I think the principle of hotel investment is really the efficiencies in the operation side. The branding helps in that element because there are entities that have, you know, honed their art in managing hospitality. From an investor's point of view, that is not really what we are known for. Those efficiencies convert into better returns. They're able to draw the type of, you know, clientele that will be sticky, will be repeating type of patrons. And so you benefit from such kind of experiences from an operator, an operator point of view. And I also think that the people who visit these establishments know what to expect when they see a certain brand, which is something that as an investor you will not necessarily give. But then when you write on the benefits of having an operator, that gives you that advantage. So yes, it helps in accelerating or accreting the returns. And I think the earlier you bring such kind of a player in your development cycle, the better.
Right, so branding clearly plays a role, but it doesn't solve everything, I think. So where does the real risk sit in this market today? Charles, let's start with you. What's an immediate walkaway trigger for you in the market?
An immediate walkaway trigger. It's a difficult one. I think the real thing for an investor is revenue. And I think when it comes to hotels, there are two main drivers, as we have come to learn. Your ADR and your occupancies are really the things that you make it to operate or to perform in the best way possible. So if those ones are not being met consistently, I think from an investor's point of view, it's time to relook and repurpose your investment thesis. Yeah.
Right. And Michael, where are you seeing deals struggle the most today? Is it the cost base, ramp up, maybe location? Where are the key challenges?
Okay, all of the above. I think the cost base is a massive issue because we've seen development costs shoot up over recent times across most of the world. And it's going to be worse in the months to come, I think, after the Middle East situation. So if your numbers are wrong in terms of your viability of the development costs, it can make operating the hotel at the end, you know, the biggest challenge. So I think deals do get strangled on that. I think coupled to that, the financing difficulties that many projects, you know, have, it also strangles a lot of deals. I think the ramp up, my reading of ramp up is really the fact that it takes a hotel typically a couple of years to get to stabilization. And often the owner developer does not necessarily have the patience to allow that to unfold. So I think the way that the deal is structured needs to always have that level of patience. Macro issues affect every project, either positively or negatively. So you've got to go into these deals with your eyes very, very wide open. And I think a lot of deals get strangled or not off the floor because of not getting that balance right between the cost, the ramp up, the financing, and then ultimately probably the right positioning of a property in a particular location.
Yeah, that's fair. Jameel, maybe on to you. How does your risk approach differ between Nairobi and secondary cities?
So for those of you who are familiar with CityBlue, it was born in Kigali in Rwanda and then opened in Kampala. But our third property was in Mombasa. So entering the Kenyan market was actually through the secondary city of Mombasa in December 2017. And we subsequently opened in Nairobi. So, and today we're also operating in Dar es Salaam. So as from our perspective, we take different types of criteria. Today one would say that the coast is more opportune than Nairobi. But 7-8 years ago, our view was that there were no branded properties of substance on the coast, that there was an opportunity, and naturally the commercial terms had to make sense. Our business model is also one whereby we have different and somewhat flexible ways of approaching a deal. One could be through balance sheet participation, one could be through long leases, and increasingly now management contracts, revenue share arrangements, and franchise. So in light of that, we are constantly looking at opportunities in secondary cities too.
So yeah, I guess Nairobi is becoming a little bit more saturated. So the question is, where does capital go next? Dan, where do you see the next growth nodes within Nairobi and potentially outside, and how should developers think about them?
I think that the traditional nodes of Upper Hill and Westlands are proven and they are becoming mature markets, and that the next generation nodes should be more decentralized in Nairobi and demand-led. So where we are seeing activity and potential would be, as I mentioned earlier, in Gigiri, in the UN corridor, to capture NGO, diplomatic, and long-stay demand, but also in Karen and Langata for some probably lifestyle or some kind of urban resort hybrid offering. The airport, I think, for logistics demand, transit stay, and airline crew, but also along Thika Highway and the Ruiru corridor, in order to capture demand in the growing urbanization of Nairobi and to capture local corporate demand. So I think that in terms of how developers in Nairobi should think, they should think less about prime CBD sites and more about these decentralized demand clusters. And this is where we as a brand and as an operator are trying to unlock real value with investors that are interested in those nodes. Because that is what is happening, is that Nairobi is becoming bigger, it's becoming sprawling. And people that live out there, especially in the middle income class, are looking for branded supply as well. So that's what I would say, yeah.
Yeah, I think that's very valid and leads us more into now secondary cities. Jameel, do you see, and which cities specifically, as genuinely investable today and which are still speculative?
Taking an East Africa-wide approach, I think Tanzania has a lot of opportunities. Dodoma, for example. Kenya, certainly Mombasa, Kisumu, Eldoret. Uganda, definitely certain Entebbe, Jinja have opportunities and so on. So I definitely would never rule out looking at secondary cities, and as you know, our approach has also been to start that way sometimes.
So maybe we can open this up to everyone. If you had $50 million to deploy outside Nairobi today, where would it go and why? JS?
Just take it and go back home. Just kidding. I think you need to understand Africa from a bigger picture perspective. What we do is, and I would agree with Daniel to a large extent, that secondary cities is the way to go. Nairobi is, there is a misconception about Nairobi that it's only relative to safaris but it's a dynamic corporate convention city, and with what just happened in the Middle East, because I'm based out of Dubai, a lot of traffic has moved towards Nairobi from an aviation standpoint as a hub too. So for me, I look at markets which need hospitality quality products. I don't go by numbers. I don't go by, well, I need to have 1,000 keys in Nairobi today. I would identify what typically is required and invest in that area. Similarly for us, we see an opportunity in Abidjan, Zambia, Nigeria, and Zimbabwe. That's where you need quality products. You really need them. You look at a place like Livingstone in Zambia, great opportunity. So you've got a hotel there, I think Radisson's got a hotel there. So I would look at the real opportunity within the African continent, identify the markets that need quality products, spend 45 million there and 5 million back to me. That's good.
Fair enough.
Thank you.
Dan?
Was the question 50 million in Nairobi or
No,
in
no, no.
East
If
Africa?
you had $50 million to deploy outside Nairobi.
Outside Nairobi, yeah. So for me, it's definitely Zanzibar. You know, we've been chasing projects there for a long time. You know, as Wayne presented earlier, it's the hottest market in the region. It has all kinds of interesting source markets from Eastern Europe to Southeast Asia Pacific, where we have a strong presence and would love to be able to send our guests there. $50 million is quite a lot. Probably take 20 million to build a decent resort. And
You can choose a couple of
give the
markets.
rest to them.
Michael?
I'm going to stay loyal to Kenya because that's where I am right now. So 50 million could go quite a long way. I got a couple of thoughts. One would be I come out of boutique luxury background, so I see big opportunity to do a circuit of different boutique experiential properties, from safari, obviously, and beach, but obviously wellness, entertainment, just facets that we see coming through as new demand kind of generators of international travelers, but also regional travelers. Or I go a different route and spend the money on the three-star segment, but at the lifestyle kind of branded space where you could build a quite nice little collection of mid-sized three-star, very appealing, very social hubs across Kenya. Same would go for East Africa, but I don't know the 50 million would go all the way across East Africa, so we'll start in Kenya.
Charles?
Well, I would also wish to keep some, but I think there's quite a lot that is happening in Kampala. Our partners, and I like what Wayne was alluding to earlier, Addis, quite strong numbers. So looking at how even the investment dynamics are looking like, those are two places I would wish to look at. Not to belabor the point, but I would still wish to keep some in Nairobi. There's quite a lot that we are doing there, and I think 50 million, whoever is giving it out, we have something that we can do together. Thank you.
Jameel?
So since the COVID period, we were one of the first to open sort of short stay, long stay type concepts in the region, and 2021 opened Skynest Residences by CityBlue. And hopefully by the end of the year, we'll be opening Divine Residences by CityBlue in Nairobi. And I think this is a concept that hasn't really taken off yet in Kampala, Kigali, Dar es Salaam, and maybe Addis. So I would split the money between those markets and perhaps focus on a product that provides the amenities, the location, the technology and service, but also ensures that during the downtimes, the properties can also attend to the long-term clients.
I think clearly there's no shortage of opportunity. So if anyone has $50 million for my panelists, please put your hand up. So I think we've tried to keep to time. If anyone has any questions, please feel free to ask. If not, I think we'll wrap it up here.
And one
Thank
thing
you.
I remembered to your question about the thing that would make somebody to walk away, I have realized the strength of a partner in this investment. I think everybody can give you a room, everybody can give you the food that you want, but it's that experience that you have with partners that make or break deals. And truthfully, I've seen deals fall through just because partners cannot agree.
Absolutely. That's a great point. Thank you very much, everyone. Thank you.
Thank you.